Hey, welcome back. Today, we are talking about one of the most psychologically powerful numbers in all of personal finance. Not $1 million, not $500,000, $100,000. And I want to explain right at the top why this specific number matters so much, because it's not arbitrary and it's not just about the prestige of saying you're a six-figure saver. The science behind why this number is special is genuinely fascinating. Charlie Munger, Warren Buffett's longtime business partner and one of the most respected investors in history, famously said that the first $100,000 is the hardest. He was blunter about it than that, but the core idea is this. Once you have $100,000 working for you, the math of compound growth starts producing results that are visible, motivating, and self-reinforcing in a way that smaller balances simply cannot. The game changes. At a historically reasonable average annual return of 8%, a $100,000 portfolio generates approximately $8,000 in passive growth in its first year alone, without you adding a single new dollar. By contrast, a $10,000 portfolio generates just $800. The same percentage return produces 10 times the real dollar result. This is why the first $100,000 is the inflection point. Above it, your money genuinely begins doing meaningful work on your behalf. So this video is about getting you to that inflection point, specifically as fast as reasonably possible, not by cutting every joy from your life or working yourself into the ground, but through a clear, systematic, research-backed approach that attacks your savings rate from both sides, reducing unnecessary spending and aggressively growing your income. Let's get into it. Chapter 1, the math. How long does it actually take? Before anything else, let's do the math, because one of the most paralyzing things about the $100,000 goal is that people don't know whether it's a realistic 3-year goal or an unrealistic 20-year goal for someone in their situation. The answer, it turns out, depends almost entirely on one variable: your savings rate. Let me walk you through some scenarios. These assume you're investing your savings in a low-cost index fund, earning an average 8% annual return, a conservative estimate based on long-run historical U.S. stock market performance. If you save and invest $500 per month, you hit $100,000 in approximately 10.5 years. If you save and invest $1,000 per month, you hit $100,000 in approximately 6 years. If you save and invest $2,000 per month, you hit $100,000 in approximately 3.5 years. If you save and invest $3,000 per month, you hit $100,000 in approximately 2.5 years. Notice what happens as the monthly contribution doubles. The timeline doesn't just shrink proportionally, it collapses. That's because at higher contribution levels, you're not just adding more money, you're also giving compound interest more fuel to work with sooner. The curve bends dramatically in your favor. Research by economist Thomas Piketty and colleagues, extended by financial planning researchers, demonstrates that wealth accumulation velocity is nonlinear, meaning that the rate at which wealth grows accelerates as the base grows. The practical implication for an individual building toward $100,000 is that every dollar added in the early stages contributes disproportionately to reaching the goal, because it has the most compounding runway ahead of it. What this math tells us is that the variable you should be obsessing over is not your investment return. You can't control that. It's your monthly savings rate, which you absolutely can control. Even moving from $500 per month to $1,000 per month cuts your timeline nearly in half. That kind of leverage does not exist anywhere else in your financial life. The key insight: the fastest path to $100,000 is not finding a better investment, it's maximizing what you feed into the machine each month. Income growth and spending reduction are the two levers. Pull both hard for a defined period of time. Chapter 2. the spending side, cutting without killing your life. Let's talk about the spending side first, because for most people, it's the faster lever to pull, and the results show up immediately in your savings rate. But I want to be very clear about the approach I'm recommending here, because I think a lot of personal finance content gets this wrong. The wrong approach is trying to cut everything, tracking every dollar, eliminating every pleasure, living as austerely as possible. The research on this kind of extreme restriction is not encouraging. It's the financial equivalent of a crash diet. It produces short-term results and long-term burnout, followed by a rebound that often leaves you worse off than where you started. A study published in the Journal of Consumer Psychology found that financial restriction, like caloric restriction, activates similar psychological mechanisms of deprivation. When people feel overly restricted in their spending, they are significantly more likely to experience financial disinhibition events, large, impulsive spending episodes triggered by feelings of deprivation, similar to binge eating after a strict diet. The most sustainable saving strategies, the research found, were those that preserved meaningful discretionary spending within defined limits. The right approach is strategic, targeted cutting. You identify the spending that's costing you the most relative to the value it's adding to your actual life, and you cut that. Everything else, you leave alone. This is not about suffering, it's about efficiency. Here's something the personal finance research community agrees on almost universally. The majority of the financial leverage in most people's lives sits in just 3 categories: housing, transportation, and food. These 3 expenses together typically account for 60 to 70% of the average American household's budget. The Bureau of Labor Statistics Consumer Expenditure Survey consistently finds that housing accounts for roughly 33% of average household spending, transportation for around 16%, and food for approximately 13%, together comprising over 60% of total expenditure. Meaningful reduction in any one of these 3 categories produces savings that dwarf any amount of coupon clipping, coffee skipping, or subscription canceling. This is important because a lot of personal finance advice focuses on the $5 coffee and the $15 streaming subscription. And while those things add up, they are fundamentally small dollar optimizations. Cutting your housing cost by $400 per month is worth 27 years of cutting daily coffees. Transportation optimization, driving one fewer car, refinancing a car loan, or moving closer to work to eliminate a commute can free up $300 to $600 per month immediately. These are the categories worth your energy. If you're renting, the most powerful financial move you can make in your housing situation is to reduce your rent as a percentage of your take-home pay to below 25%. The conventional advice is 30%, but for someone aggressively pursuing $100,000, 25% or below creates significantly more breathing room in your savings rate. Specific strategies that the data supports: house hacking, buying a small multi-unit property, living in one unit and renting the others, is one of the most powerful wealth-building strategies available to people under 40. A duplex where your tenant's rent covers your mortgage payment effectively gives you free housing while your property appreciates. Even in expensive markets, the math often works when structured correctly. Getting a roommate in an existing rental can reduce your housing cost by 40 to 50% overnight. For someone paying $1,800 per month for a 2-bedroom, splitting that cost saves $900 per month, which is $10,800 per year added directly to your savings rate. Almost nothing else you do will produce that result this quickly. Geographic arbitrage, deliberately choosing to live in a lower cost of living area, either by moving neighborhoods or for remote workers, moving cities or states, can reduce your total cost of living by 20 to 40% with no reduction in income. Research from the National Bureau of Economic Research found that geographic mobility, specifically moving to lower cost of living areas or areas with better income to cost of living ratios, was one of the strongest predictors of wealth accumulation among working age adults in the bottom and middle income quintiles. The mobility premium, in terms of wealth built over a decade, often exceeded $50,000 compared to geographically immobile peers with similar incomes. Beyond the big three, there is almost always a category in your personal budget that is spending significantly more than you realize and delivering significantly less value than you'd expect. Finding it requires a spending audit, a process that sounds tedious, but done once with fresh eyes is genuinely revelatory. Here's how you do it. Pull up the last 3 months of your bank and credit card statements. Categorize every transaction, not to judge it, just to see it clearly. Then ask yourself one question about each category. If I had to pay for this in cash in front of someone I respect, would I still pay for it? The things that pass that test, the gym membership you actually use, the dinners with people you love, the hobby that genuinely brings you joy, keep those. The things that fail the test, the subscription you forgot you had, the convenience food you buy when you're tired rather than choosing it deliberately, the recurring charges you signed up for and haven't thought about since, those are your leak. Plug them. A 2024 survey by C+ Research found that the average American underestimates their monthly subscription spending by over $100 per month. When participants were asked to estimate their total monthly subscription costs before reviewing their statements, the average estimate was $86 per month. The actual average, revealed by statement review, was $219 per month, a 155% underestimation. The gap between perceived spending and actual spending is where a significant portion of your savings rate is hiding. Chapter 3. The income side. This is where the real acceleration happens. Here's the thing about cutting expenses. It's a finite game. You can only cut so far before you're living in a way that isn't sustainable or enjoyable. But income has no ceiling, and the research is very clear that for people who want to build wealth faster than the average trajectory, income growth is the variable that makes the biggest difference. A longitudinal study by the Rand Corporation tracking wealth accumulation among adults aged 25 to 50 found that income growth rate, not starting salary, not savings rate alone, and not investment returns, was the single strongest predictor of reaching significant wealth milestones by midlife. Specifically, individuals whose income grew at least 3% per year in real terms above inflation accumulated on average 3 times more wealth by age 50 than those whose incomes stagnated, even when starting from the same base. 3 times more wealth from income growth alone. That is the most important number in this entire video, and I want it to really land. The person who grows their income aggressively while maintaining a reasonable savings rate will almost always reach $100,000 faster than the person who cuts spending alone. Strategy 1. Maximize your primary income first. The single highest leverage income move for most people is optimizing their primary job compensation. This sounds obvious, but the data on how underpaid most people are and how rarely they do anything about it is striking. A 2023 report by LinkedIn Economic Graph Research found that employees who changed jobs experienced salary increases averaging 8.4% to 10.2% year over year compared to average annual raises of 3 to 4% for employees who stayed at the same company. Over a 5-year period, a job changer who moved strategically once every 2 to 3 years earned on average 20 to 30% more than a comparable peer who stayed put and relied on internal raises. The implication is direct. If you haven't negotiated your salary recently, or if you've been at the same company for more than 2 years without a significant pay increase, there is a very high probability that your market value is meaningfully higher than what you're currently being paid. And the fastest way to close that gap is not patience, it's a competing offer. Practical steps that research supports. Use salary benchmarking tools, Glassdoor, Levels.fyi for tech roles, LinkedIn Salary Insights, the Bureau of Labor Statistics, Occupational Employment and Wage Statistics, to establish your actual market rate. Go in with data, not just a feeling. Build a case for your value before negotiating. Track your measurable contributions, revenue generated, costs saved, projects delivered, team members mentored. Quantified impact is significantly more persuasive in salary negotiations than tenure or general good performance. Interview externally at least once a year, even if you're happy in your current role. Understanding what the market will pay you is valuable information, and occasionally a competing offer is the only language that produces a meaningful internal raise. Target industries and roles with above-average salary growth trajectories in 2026, technology, data and AI roles, healthcare specialties, and skilled trades continue to offer compensation growth significantly above the median for comparable experience levels. Strategy 2. Build a side income stream. The second income lever, and the one that can accelerate the $100,000 timeline most dramatically, is adding a side income stream that is specifically earmarked for your savings goal. Not for lifestyle, not for extra spending. Every dollar from the stream goes directly to the $100,000 pile. The psychological mechanism here is important. When you mentally account for side income as money for the goal rather than extra spending money, it is insulated from lifestyle creep. Research in behavioral economics confirms that mental accounting, the way people categorize and treat different sources of money, is a powerful tool for directing behavior, even if the dollars are functionally identical. Research by Drazen Prelick and Duncan Simster, published in the Journal of Marketing Research and extended by later behavioral economics work, found that people spend significantly differently depending on the mental account they assign income to. Participants who categorized extra earnings as savings money saved 68% of it on average, compared to 24% among those who categorized the same earnings as general income. The label shapes the behavior. What kind of side income? The options in 2026 are genuinely broader than they've ever been, and the research on which approaches work best consistently points to the same principle. Monetize a skill you already have rather than learning a new one. The ramp-up time is shorter, the quality ceiling is higher, and the income arrives faster. Freelancing or consulting in your primary field, writing, coding, design, marketing, finance, engineering, healthcare, is the highest margin starting point for most people. Platforms like Upwork, TopeTal, and direct LinkedIn outreach make finding the first client easier than it's ever been. Teaching or tutoring, if you have expertise in any in-demand subject, academic, professional, or vocational, tutoring and online course creation have remarkably low startup costs and scalable income potential. A single Udemy course or a small roster of private tutoring clients can generate $500 to $2,000 per month with a one-time content investment. Gig economy work, rideshare, delivery, task platforms has a low skill barrier and near zero startup time. While not the highest hourly rate available, it is immediately accessible and can generate $400 to $800 per month with 10 to 15 hours of weekly effort. Selling physical or digital products, reselling on eBay or Facebook Marketplace, print on demand, digital downloads, or Etsy shops are asymmetric. Low time input for potentially disproportionate returns if the product resonates. A 2024 McKinsey Global Institute report on the future of work found that individuals with side income streams, regardless of amount, reported higher overall financial resilience scores, lower financial stress levels, and were significantly more likely to reach savings milestones ahead of schedule compared to single-income earners with comparable total incomes. The diversification of income sources, not just the additional dollars, contributed independently to financial stability. Chapter 4. Where to put the money as it builds. Building your savings rate is the hard part. Deciding where to put the money while you accumulate toward $100,000 is actually pretty straightforward, but getting it wrong can meaningfully slow you down, so let's address it directly. Phase 1. The emergency fund first. Before a single dollar goes toward the $100,000 goal, you need a financial shock absorber, 3 to 6 months of essential living expenses, rent, food, utilities, minimum debt payments, sitting in a high-yield savings account that you do not touch under any circumstances except a genuine emergency. In 2026, high-yield savings accounts at online banks, Marcus by Goldman Sachs, Ally, Discover, and others, are offering annual percentage yields that make parking your emergency fund there genuinely worthwhile, rather than leaving it to waste in a 0.01% standard savings account. At current rates, a $15,000 emergency fund can earn $600 to $750 per year in interest, doing absolutely nothing. The Consumer Financial Protection Bureau's research on financial stability consistently finds that households with 3 to 6 months of liquid savings are dramatically more resilient to income disruptions and unexpected expenses, and critically, are far less likely to liquidate investment accounts or take on high-interest debt when shocks occur. For someone pursuing the $100,000 milestone, this buffer is what prevents a single emergency from derailing months of disciplined saving. Phase 2. Capture every free dollar. Employer match first. Once the emergency fund is in place, your very next move is to contribute enough to your employer-sponsored retirement plan, a 401k or 403b, to capture the full employer match. This is not optional advice. This is the closest thing to a guaranteed 50 to 100% instant return that exists in legal investing, and skipping it is leaving free money on the table. The Vanguard How America Saves report found that approximately 25% of eligible employees failed to contribute enough to their 401k to capture their full employer match. For the median employee missing the full match, this represents an average of $1,336 per year of foregone free compensation, money that compounds tax-deferred over decades. Over a 30-year career, uncaptured matches can represent $200,000 or more in lost wealth. Phase 3. The dedicated $100,000 account. Here's a behavioral strategy that research strongly supports. Open a dedicated savings or investment account specifically labeled for the $100,000 goal. Not your regular savings account, not your checking account. A separate account with a name that reflects the goal, whether you call it 100K fund or financial freedom account or whatever resonates with you. The reason this works comes back to mental accounting. When the account has a specific name and a visible balance tracking toward a visible goal, the psychological research shows you are significantly less likely to redirect those funds towards consumption and significantly more motivated by seeing the balance approach the milestone. Research in goal-setting theory by psychologists Locke and Latham, consistently replicated across multiple decades and domains, finds that specific, challenging goals with visible progress feedback produce significantly higher performance outcomes than vague or unchallenging goals. Applied to savings, people who set a specific savings target, such as $100,000 by December 2028, and tracked visible progress toward it, saved an average of 30 to 40% more than those with a general intention to save more. For this dedicated account, in 2026, you have good options. A taxable brokerage account at Fidelity, Schwab, or Vanguard invested in a low-cost S&P 500 index fund or total market index fund. If your time horizon to hit $100,000 is 3 to 7 years, the market's growth component will meaningfully accelerate your timeline beyond what a savings account can achieve. A high-yield savings account for the portion of your goal that you're less than 2 years from reaching, keeping near-term money safe from market volatility while still earning meaningful interest. I-bonds from treasurydirect.gov for a portion of your savings, government-backed, inflation-protected, and currently offering competitive yields, limited to $10,000 per person per year, but a solid component for a diversified savings strategy. Chapter 5, The Behavioral Secrets, What Separates People Who Hit the Goal from Those Who Don't. I've talked to a lot of people who understood everything about saving and investing, every concept I've covered today, and still didn't hit their goals. And I've met people who knew relatively little about the mechanics and were well on their way to $100,000. The difference was almost never knowledge. It was behavior. The single most powerful behavioral tool for reaching $100,000 is automation. Every recurring financial decision that requires willpower to execute correctly is the decision that will eventually be made incorrectly. Human beings are not good at consistently choosing the disciplined option when a more comfortable option is immediately available. The research on this is overwhelming. A landmark 2001 experiment by psychologist Roy Baumeister and colleagues found that willpower is a depletable resource, a finding that has been replicated broadly across behavioral science literature. Financial decisions made later in the day, after other demanding choices, were systematically less disciplined than those made earlier. Automation removes the decision entirely, which means it removes the dependence on willpower. The transfer happens whether you feel like it or not. What to automate? Your monthly investment contribution, set to transfer on payday, your emergency fund top-up if it ever gets used, your retirement plan contribution, and, if possible, a 1% automatic contribution increase once per year. Set these up once and let the system run. Here's something that personal finance content almost never mentions, but that behavioral science is very clear about. Your likelihood of reaching a financial goal is substantially higher if you tell someone about it and structure some form of accountability around it. Research by the American Society of Training and Development found that the probability of completing a goal is 65% when you commit to someone else and rises to 95% when you have a specific accountability appointment with a person you've committed to. This effect, known as social commitment theory, is one of the most robust findings in goal achievement research and applies directly to financial targets. Find one person, a partner, a friend, a sibling, even an online community, and tell them your goal. Tell them the number and the timeline. Agree to check in monthly, not for judgment, but for celebration and accountability. Make it social. The data says it matters more than any individual strategy covered in this video. There is one force more reliably destructive to the $100,000 goal than any market downturn, any unexpected expense, or any bad investment decision: lifestyle inflation, the tendency for spending to expand to fill available income, regardless of how much income grows. Every time your income increases, whether from a raise, a bonus, a promotion, or a side hustle, there is a psychological window of approximately 30 days before your lifestyle adjusts to the new income level. In that window, every dollar of the increase is still extra. After 30 days, it's just normal. The research calls this hedonic adaptation, and it is the silent killer of every financial goal that doesn't have a pre-committed savings rate built into it. Research on hedonic adaptation by psychologists Shane Frederick and George Lowenstein demonstrates that individuals adapt to income increases within weeks, returning to baseline levels of financial satisfaction regardless of how significant the raise was. The practical implication: without a pre-commitment to redirect income increases directly to savings before they enter your spending baseline, raises produce very little lasting improvement in actual wealth accumulation for most people. The defense is simple, but it must be pre-committed. Before every expected income increase takes effect, update your automatic investment contribution to capture at least 50% of the net after-tax increase. Half goes to savings, half improves your life. This is the 50% rule of raises, and it is one of the most effective tools for accelerating the $100,000 timeline without requiring ongoing willpower. There is a reason every serious athletic training program involves tracking performance metrics, and every weight loss program involves a scale. Visible progress feedback is one of the most powerful motivators known to behavioral science, and it works for savings goals just as powerfully as it works for physical goals. A study published in the Journal of Marketing Research found that people who tracked their progress toward a savings goal visually, using a chart, graph, or even a handwritten tracker on the wall, were 2.4 times more likely to complete the goal than those who tracked mentally or not at all. The visibility of progress, not just the awareness of it, was the critical factor. Keep a simple tracker, a spreadsheet, an app, a sticky note on the bathroom mirror that shows your current balance against your $100,000 target. Update it monthly. Watch the number move. Celebrate the milestones. 10,000, 25,000, 50,000, 75,000. Each one is meaningful. Each one proves the system is working. And that proof, visible, concrete, and undeniable, is what sustains the behavior through the inevitable difficult months. Let me close with something I want you to really hold on to. The $100,000 milestone is not just about the money, it's about what the money proves. It proves that you can set a hard goal and follow through on it. It proves that you can exercise financial discipline over an extended period of time. It proves that you are the kind of person who finishes what they start. And that proof, the identity that comes with achieving this milestone, is arguably more valuable than the $100,000 itself because it's the foundation everything that comes after is built on. Here is your action plan, step by step. This week, do the spending audit. Print or export 3 months of bank and credit card statements. Find the biggest leaks. Cancel or renegotiate the ones that don't pass the "would I pay this in cash in front of someone I respect." This week, research your market salary. Use Glassdoor, LinkedIn Salary, and the BLS OEWS data to find out what your role pays in your market. If you're below the median, put salary negotiation or job search on your calendar within the next 60 days. This month, open the dedicated account. Name it something specific. Set up the automatic monthly contribution from your paycheck. Even if it's $200, start the habit immediately. This month, identify and launch one side income stream. Pick something you already know how to do. Reach out to 3 potential clients or list your first service. The goal this month is revenue, not perfection. Capture your employer match. If you haven't already confirmed you're contributing enough to get the full 401k match, log in today and fix it. This is immediate, guaranteed, free money. Set up the tracker, a spreadsheet, a whiteboard, an app, whatever you'll actually use. Put your starting balance and your $100,000 target on it. Mark today's date, set a monthly reminder to update it. Tell someone. Find your accountability person this week. Tell them the goal, set the first monthly check-in. Make it real by making it social. The first $100,000 is the hardest, not because the math is complicated, but because it requires a sustained commitment of effort, attention, and discipline over months and years in a culture that is constantly trying to redirect your money toward immediate consumption and away from future wealth. But you're watching this, you're thinking about this, you're building the plan. That already puts you ahead of most. Now go execute it. Thanks so much for watching. Drop your starting balance in the comments, even if it's 0, and your target date. Let's hold each other accountable. Like and subscribe if you want the next one in this series. See you there.